Hi everyone, this video is for UK residents only because we're going to be talking about tax as well as ISA, so individual savings account. So the first thing to point out is that every year in the UK you have access to £20,000 in your ISA, and that can be split evenly across all the different ISA types, such as cash ISA, innovative finance ISA, such as lifetime ISA or help to buy, as well as stocks and shares ISA. Or you can just entirely put the entire basket into, let's say, stocks and shares ISA. But what you cannot do is put 20 grand in each one of those because that would total 60 grand instead of 20. And the thing that is special about ISA is that whatever capital gain that you have, so whatever return, is completely tax free. So you want to maximize that 20 grand. And that is the main difference between an ISA and a pension scheme. So let's say you have your company pension scheme. What it does is that you salary sacrifice some of that money um, to go into a pot that then returns some amount of money because that pot will be investing in index funds. But 15%, so 1/5 of the returns, will actually be taxed on the pension scheme. So that is the part of the cons on the pension scheme. But the pros on the pension scheme is the fact that you can salary sacrifice, but then your taxable income will be viewed as lower, so therefore you pay less tax on your salary. A pension scheme is good for people who are earning more than 50 grand because then whatever, if you look at the tax bands, for instance, whatever it would be taxed at 40% tax rate, it will instead be taxed at 20% tax rate. So you'll be saving 20% of the part of the salary that would otherwise be in a higher rate. Um, and also another thing about pension schemes that is important is that most companies they match a certain percentage. So you want to make sure that the company is giving you as much as you can receive from their pension scheme. Um, but now let's just jump into the different type of ISA. So the first one is that I want to talk about is the help to buy ISA. So that is a lot of people know this. This is only if you want to buy your first home. So and the thing that is special about this help to buy ISA is that whenever you put 200 pounds per month, the government tops up with 25%. So they top up with 50 quid. So and that enables you to, if when you maximize it, it enables you to total 12 grand of entry, so the money that you put down, and the government will give you back 3 grand. So that is free money from the government, and most of the accounts, so for instance, the Barclays one, it returns to you 2%, which is not that bad a year, which would be a normal savings account. Now let's go to the lifetime ISA. So lifetime ISA is actually much better than Help to Buy ISA, but the thing is you can have both. So you can use the Help to Buy ISA to buy your first home, and you can use then the lifetime ISA to retire. So the lifetime ISA you can use for two reasons actually. So you can use to withdraw for your first home, or you can withdraw after you turn 60. So either for your retirement or for your first home. And the thing about that is also special about lifetime ISA is that the government will also top up 25%. But rather than 200 quid per month limit that you have in the Help to Buy ISA, in the lifetime ISA you can put 4 grand per year. So the government will give you 1 grand back per year. So it's about 1,600 more per year that you can put in a lifetime ISA when you compare against a Help to Buy ISA. But as I said before, I have both for myself, so you should try to have to maximize it. You should try to have both too. So one thing though is that this money should be money that you're saving to not withdraw. So you should avoid withdrawing this money, otherwise you won't maximize the benefits on it. And the other constraint that we have is that you can only open a lifetime ISA if you are between 18 years old and 39 years old. So that's all.